So let's have a look at learning objective number 2 that looks at analyzing the effect of the accounting transactions on the accounting equation. So let's start with what are transactions? Well, basically transactions are any activity that crosses the economic entity border or boundary. Right? So we looked at the economic entity concept a few weeks back in workshop 1, and what you learnt about that is when we report financial information, we are only interested in what happens within an economic entity from a financial performance and position perspective. So if anything crosses over that economic entity boundary, then we need to account for that transaction. So that is what a transaction is, something that crosses the economic entity boundary, right? So every single transaction has a source and it always has a use. So for example, if I purchase this pillow, right? So it's a pillow with a cat head. Okay. I bought it somewhere not too far from the UTS tower. I'll let you work that out. Anyway, so this is the use of the source, which was the cash I paid for the cat head, right? So I paid $5 for the cat head, right? That was what I used up. And so every single transaction has a source and it always has a use, right? So I go to the shop across the road from the UTS tower and I spend, say, $5, right? This is what I'm using up, right? And for that $5, I get this, okay? Cat head pillow, right? It's a pillow, okay? I'll let you work out where I purchased this from, but it wasn't too far from the tower. Okay, so whenever we account for anything, we're interested in what the source is and what the use is, right? And so for every single transaction, there is at least 2 different accounts that are affected as a result. And why we always affect at least 2 accounts will become very clear shortly. So all accounting transactions obviously must be recorded in the accounting information system so that we capture all the information about business performance and position. And the easiest way to understand how to record transactions is to refer back to the accounting equation, which is assets equal liabilities plus equity. Now, I've written this down on a piece of paper here, yellow piece of paper. I've written assets equal liabilities plus equity. Now, I want you right now to take a piece of paper and write that equation on it. It's very important that you do this right now because we're going to build on this equation and add a few details as we move along with today's workshop so you can better understand the accounting transactions process. Please do that now. So now that you've done that, and now that you've written out the accounting equation on your piece of paper, let's have a look at a series of transactions for an example firm, Circle Films, for March. Okay, so transaction 1 is after incorporating, Circle Films issues 3,000 shares to investors for $15,000 cash. So how do we capture this transaction within our accounting equation? Assets equal liabilities plus equity. Right. So basically what we want to do is we want to write the effect on each side of the accounting equation. Now, the first thing is, if we receive $15,000 of cash in the business, that increases our assets of cash by $15,000. So we add $15,000 on the asset side. And if investors have invested $15,000 in the business, then they have a $15,000 equity stake in that business. So the contributed equity, which is within the equity section of this accounting equation, increases by $15. So both sides of the equation increase by $15 as a result of the transaction that has just occurred. And as you can see, both sides of the equation balance. 15,000 equals 15,000. And as I said, the accounting equation always balances. It's never out of balance. If it's out of balance, you've done something wrong. Okay, so what I want you to think about now is this question. So the question you just answered relates to transaction 2 that we're looking at here. And it asked you to describe what the effect on the accounting equation was of purchasing a video camera for $9,000 and memory cards for $1,000, right? Now, what we're doing here in the question you were just asked is you were informed that these purchases were done by paying the supplier in cash. Now, the question that you were just asked relates to transaction 2, and in particular, in transaction 2, you were informed that the purchase of the video camera for $9,000 and the memory cards for $1,000 was undertaken through paying the supplier in cash. So what is the effect of this on the accounting equation? Now, if we go back a step and we think about the effect of the last transactions on this equation, right? So the last transaction, we had owners contributing $15,000 in cash to the business. So therefore, equity went up by $15,000 and assets went up by $15,000. Now, after transaction number 2 that we're looking at here, the purchase of the video camera and the $1,000 in memory cards, what you can see is that assets remain exactly the same. So why would this be the case? Now, if we go back to the cost principle that we looked at in workshop 1, the cost principle says you value assets that you acquire based on the amount you pay for them, right? So if we have cat head here, right? I pay $5 for the cat head pillow, right? The value of this asset is $5 accordingly, right? So we're exchanging one asset of cash of $5 for another asset that's worth supposedly $5. And so therefore, the asset balance in this accounting equation that you're looking at here remains exactly the same, right? All that's happening is that your cash is decreasing by $10,000 and the supplies and equipment in total, are increasing by $10,000. So therefore, you still have $15,000 worth of assets left, right? So your accounting equation still balances, but the composition of assets as part of that accounting equation is redistributed. Let's move on to transaction number 3. So in transaction 3, it says that Circle receives $1,500 payment immediately after filming a customer's wedding. So how does this affect the accounting equation? Well, how it affects the equation is in 2 ways. First, the assets are increasing because the business has received $1,500 in cash, right? So cash increases from $5,000 plus $1,500 to $6,500, which means that the total assets in sum, when you add cash to your supplies and equipment, equals $16,500. Now, obviously the $16,500 needs to match the other side of the accounting equation. And we can see over here that the equity side has increased by $1,500. Now, when businesses generate profit, that profit flows to retained earnings, right? So this means that the profit is added to the retained earnings section of equity. So when a business generates $1,500 in revenue for completing a service, we add the $1,500 to the equity side of the equation, and therefore we have a $16,500 total on the liabilities and equity side, which matches the asset side. So again, we're still in balance. Now, I want you to note something very important here. Yes, we did add this $1,500 that was associated with revenue to retained earnings. And at the end of the period, we will record what we call a closing entry that will shift our profits to our retained earnings account. However, when revenue is recorded at the time it occurs, so at the time transaction 3 occurs, you never ever touch the retained earnings account. Don't touch it, okay? Do not touch this account ever until you record the closing entries, which I will be showing you in next week's workshop. So if you generate $1,500 in revenue, you increase the revenue account by that amount. Let's have a look at transaction 4. Transaction 4 says Circle receives a $2,000 deposit from a customer to film her parents' 50th wedding anniversary. So how does this affect the equation? Well, the first thing obviously that happens is that cash is increased by $2,000 because the business has received now $2,000 in cash. So that pushes the asset side up to $18,500. How does this balance against the other side? Well, obviously the equation always needs to balance, so something needs to happen over on the other side of the equation. So you can see here that we add 2,000 to the liabilities section of the accounting equation. And we specifically call this liability unearned revenue. Now, what is unearned revenue? Now, some of you unfortunately have booked flights recently, for example, through Qantas. And if you log on to Qantas's website, you'll probably see something like this. It says flight credits extended to 31 December 2021. If you are holding a Qantas ticket for travel before 31st of July 2020, you can now get a credit valid for booking and travel by 31 December 2021. So Qantas is therefore holding your money for a flight that you've paid for, but you have yet to use. And if it was booked in the next few months, it's likely to be cancelled, right? So how do they actually record that money that they hold, but have yet to deliver the service to you? Well, we refer to this as unearned revenue because Qantas has not earned the revenue. It is unearned. And this is a liability because Qantas owes you that service some point in the future, right? And so accordingly, if we accept money from a customer, but we are yet to deliver the service to them, then we need to increase the liabilities accordingly. So both sides of the equation, the cash and the unearned revenue side, assets and liabilities respectively, are increased by 2,000. So therefore both sides add up to 18,500. Let's have a look now at transaction number 5. And transaction 5 says Circle paid $250 cash to run an ad in the local paper. Now, if Circle is paying cash for this ad, what happens to our accounting equation? Well, first thing is obviously that happens is that cash decreases by $250, right? So that decreases the asset side by $250. And on the other side, we can see here that the retained earnings decreases by $250. Now, two things that I want to talk about here. The first thing is, as I mentioned before, you never ever use the retained earnings account until you get to the end of the period and record the closing entries, which I will show you at the end of next week's workshop, how to record those closing entries. What you do with this $250 is you record it to an account called expenses. So in this case, it is an advertising expense, right? And the effect of the advertising expense is ultimately it will reduce retained earnings and it will reduce equity by $250, which is how we are reflecting it here in this particular slide. That's the first thing that I want to tell you about. So you can see as a result of this transaction that assets go down by 250, equity goes down by 250. So again, both sides of the equation balance. Some of you may wonder why we are expensing advertising expense when it may have future economic benefit, which is consistent with the definition of an asset. And that's a good question. So let me give you an example of this. So let's have a look at this picture here. This is a billboard advertisement for McDonald's. You can see there that bag some dinner, and then they've got the big bag there, right, etc. I suppose very topical in these times where people don't want to sit in a restaurant and eat something, so they just want to get takeaway and leave, or they have to, according to the government regulations, depending on where you live. Now, this advertisement, people may remember for days to come, weeks to come, maybe years to come, and that might affect their decision about whether to go to McDonald's and therefore drive McDonald's revenue going forward to some degree. So the question is then, well, if we go back and we look at how we recorded this particular transaction, we reduced equity by $250 because we are incurring a $250 expense. Now, if that's the case, we're expensing it, which means we are assuming that we have completely used up that resource. When for advertising, it's probably going to have some sort of ongoing benefit. Can we actually work out what the ongoing benefit of this billboard is exactly, and how long the effect will be on encouraging customers to buy McDonald's meals? Well, we can't. And there's an accounting principle that's called the conservatism principle, which again we looked at in week 1, that says that, you know, if we are unsure about whether or not we should expense something, or unsure about the nature of expenses and how much they actually are, then we should expense them, right? So we are not sure how long the McDonald's ad will have an effect on customers' buying behavior. So therefore, we expense the whole amount at the time that amount is paid, which is why when transaction 5 occurs, we record an advertising expense on that day. Now, before I go through transaction number 6, I would like you to answer this question and think about the effect of transaction 6 on the accounting equation. So here's transaction 6. It says Circle films a dance competition, leaving a $3,500 invoice with the customer. So the customer has yet to pay in cash. They haven't paid any cash, but the business has delivered the service to the customer. So does the customer owe us money? Well, yes, they do, because we have done something for that customer. They owe us $3,500. So what we call this is an account receivable. We have an account that is receivable in the form of cash from a customer. So therefore, the asset side of the equation increases by $3,500. Now, we have met our obligations to the customer. We have delivered the service we promised, and so therefore we have earned the revenue. And when you have earned the revenue, you record the revenue. So that means when you've delivered the service and met your obligations to the customer, you record that revenue. And what you can see here is that the retained earnings side of the equation is going up. So that means we have recorded service revenue of $3,500, and accordingly the equity side goes up by $3,500 too. So if you look at both sides, once again, they both match. Let's move along and let's look at transaction number 7. Transaction 7 says Circle purchases another $9,000 video camera by signing a 9-month promissory note. So what is a promissory note? Well, it is a current liability. So that is a short-term liability that businesses generally repay within a year. So they have acquired an asset that's worth $9,000. So equipment goes up by $9,000. That's obviously an asset. That increases the asset side. The business has taken out a loan. So we have notes payable, the 9-month promissory note. That increases by $9,000. Liabilities go up $9,000, and again, the accounting equation balances. Now, if we go back to transaction number 2, in transaction number 2, we saw that Circle purchased a video camera for $9,000 and memory cards for $1,000. Now, what's the difference with this transaction versus transaction 7 that we were just looking at? Well, the difference here is how do we actually fund this transaction? In the first case, in transaction 2, we funded it through our own cash, so the cash that was in the business. So So therefore, one asset was exchanged for another, and so therefore the assets remain exactly the same after that particular transaction. Now, if we go back to transaction number 7, we are not exchanging one asset for another in this case at the time of the transaction. We are taking out a loan to buy the asset of 9,000 here, right? So remember, as I explained the accounting equation, a couple of weeks ago, I said that the business's assets are funded by two things. You either borrow the resources, which is happening in this case, or the owners contribute equity to the business, which allows the business to then acquire assets, right? So we know that the owners contributed $15,000 to the business originally, which is where that $15,000 came from there. And that $15,000 has been used to purchase a number of things, including the video cameras in transaction 2 and the supplies in transaction 2. And that was how we funded that initial transaction. In this case, we funded it with transaction 7 through borrowing money. So 9,000 liability there funds that asset there. So the last question I would like you to answer for the purpose of this particular workshop component, learning objective number 2, is this question. Now in this transaction 8, it says Circle receives $3,500 from the customer in payment of the open invoice from transaction 6. So remember I said in transaction 6, Circle delivered the service, but the customer had yet to pay. And that's normal in business. Businesses frequently do services, builders, suppliers of trade materials, plumbers, etc., complete work prior to being paid. Now, they have an accounts receivable from their customer accordingly. The customer owes them that money. So in this case, in transaction 8, what is the effect on the accounting equation of transaction 8? Well, really the effect is, in overall terms, no effect. Assets remain the same. We exchange one asset for another asset, right? So $3,500 in accounts receivable is exchanged for $3,500 cash, right? One asset is transferred to another. So it doesn't change the assets. Does it improve the asset position of a business? Well, think about it. If you're in business, do you want to be owed money from someone, or do you actually want the cash? And the answer is obvious. You want the cash. So this is a better position because cash is more liquid. You have it on hand. You have it available to spend on what you want when you want to. Let's now look at transaction 9. Transaction 9 says Circle pays wages of $2,000 to its employees. So if it pays $2,000 in wages, then cash decreases by $2,000 and assets therefore accordingly decrease by $2,000. And wages expense, which is summarized here in retained earnings, increases by $2,000. Now, given wages expense reduces the value of a business like any expense does, the retained earnings are reduced by $2,000. And so the liabilities and equity side, which is the reason for the change on this side, decrease by $2,000 and the accounting equation still stays in balance. Let's now have a look at transaction 10. Transaction 10 says at the end of the month, Circle pays its owners a $1,500 cash dividend, right? So remember that we are still treating the business, like always, as a separate entity. The entity of the business is separate from the private affairs of owners, shareholders, etc. So therefore, if your business takes money out of the business accounts and pays the owners, you, money, you are taking it out of the economic entity of that business and you are transferring it to the separate economic entity of the owners, right? So accordingly, we take $1,500 cash out of the business. That reduces the asset side by $1,500. And we take $1,500 out of equity, which reduces the retained earnings account through the dividends account, which this money is paid out of. And so therefore the equity value of the business goes down. Okay, so note we are taking $1,500 out of the business, reducing the value of that economic entity and giving it to someone external to that entity, which is the owner. So that's why the equity value is going down. Okay, so that's the 10 transactions I want to show you for today. In the next learning objective, we're going to have a look at how those transactions actually enter our accounting information system.